Right? We are in an environment where I think we both agree risk is being repriced. It went from being a non-factor to being a factor. And we gave several examples of where money has been used inappropriately. And now the 1%, the hedge funds, all these folks are going to be looking at risk differently. So where do you think money goes as we kind of reprice risk?
Yeah, so some of it is still going into risk assets. That's why we saw the relief rally, because the Fed really hadn't done anything yet. They came out, they talked, and they said, we're going to do these things, but nothing had happened yet. We saw a nice bounce after the war invasion. When Russia invaded Ukraine, started the war, we saw a sell-off in the markets as a knee-jerk reaction to that. Once the markets digested what was happening, then they took a look around and said, okay, where do you deploy now? You've got possible recession, you got a lot of inflation, you've got the Fed. In a couple of months, they're going to start actually doing something instead of talking about it. And you have the war. Okay. So once all that was digested, where do you get yield? Well, the only place was really in the market still. That was the only place for yield. Now that's becoming more, like you said, repricing of that risk, because there's more downside in the markets than there is upside moving forward, because now we have clarity of what the Fed's going to do. We know they're going to reduce the balance sheet and raise at the same time at a rapid pace. So the markets understand what that means. There's no money left to play with. So now where do you find yield? Well, bonds have gone up a little bit. They're going to continue to go up, but that's not exciting enough. So I think where you see a lot of this capital going now, some of it's still going to go into risk assets once the repricing is done. But I think you're going to see a lot of that capital start to go into real estate, start to go into probably bonds as they get up in the fours, the threes and fours. You'll see a lot of that big capital, life insurance, pension funds, sovereign wealth funds going into bonds again, which pulls liquidity out of the risk asset markets, which is why we're seeing them deflate right now. So I think those are your big plays. And I think that big money is looking at real estate a lot differently than they've ever looked in the past.
Yeah, I think that this is so interesting because it kind of marries the dot-com crash with my study of the 70s and 80s. It's so weird what's going on. So when I think about risk capital being repriced, the first thing I asked is something you brought up. At what rate does the 10-year note get interesting, the 10-year treasury? And for me, I think it is 4%. I think there's a lot of people that will just take the sure 4% versus maybe getting 6 or 6.5 somewhere else. There's one thing to get less than 1% in 10-year money. It is very different to get 4%. And you got to remember, we're in a worldwide economy. And there's still many economies that are still negative, right? Japan, Germany, they have negative rates. So if you can get 4% in a 10-year treasury instead of negative in your country, that's an 800% difference or whatever. So
yeah, zero risk environment. And then you look at, well, what's your next best alternative to that? And then you're talking about real estate where you've got, 3 and 4 caps. So it's like there's risk there. You have zero risk over here. So, you'll see the bond market start to get really, really attractive. And then, real yields in, equities, I don't know if the S&P can deliver that 10%, going into the next couple of years, given the monetary policy and QT environment that we're facing.
Do you think 4% is the number on the 10-year? I just picked it because it was a round number. Maybe it's 3.9, 4.1. I don't know, but 4%.
Yeah, I think that's what everybody's targeting right now.
Yeah. Because again, it's up. It's up again today. I wrote it down. I think it was 277, 276, something like that this morning. It's off a base that was below 1% seemingly 18 months ago. So yeah. So the first thing I think happens is if the 10-year gets to 4%, I don't even think it's if, I think it's when, right? Because again, if you're talking a Fed funds rate of 2.75 or even 2.5 by the end of this year, it is not impossible for the 10-year to be 4% if the Fed funds is 2.5. That's about the right spread, right?
Yeah. I'll agree with that.
Yeah. Because again, today, the Fed funds is a quarter or, 0.375, I think. And the 10-year is 2.7. So that's a 2.2 spread. So yeah, it makes sense, right? If the Fed gets to 2.5, that the 10-year is at 4 or higher. So that's the first place you go. And then the other thing you brought up is real estate. I think most people don't realize the dot-com crash took the NASDAQ down 80%. That's where I was. A lot of startups like mine, we were just days away from filing our S1 to go public. The world changed. Poof. We were laying off people inside 90 days because the world changed. And people went to real estate, right? They saw their 401ks become 201ks. They saw their tech stocks become worthless because again, people went bust. And they said, I want hard assets. It's funny that I think residential real estate may get a look more and more if the stock market gets truly hammered, because it's, hey, do I want to be over here with, CEOs that can go to jail, my experience, Enron and WorldCom, or do I want a hard asset? We could do that again, whether it's .com or crypto, right? There's going to be a lot of people that made a lot of money in crypto and didn't sell, which means they really didn't make it. But now they're going to see losses, and maybe they go to hard assets, right? Forget that stuff. I'm going to go to hard assets. What do you think of that?
Yeah, I mean, you'll see that capital rotation. We saw a lot of it, people making profit back in the .com bubble. Yeah, that's when I got my start, and they were pulling profits out of the markets going into real estate. You see that a lot in real estate. You see people that will use to buy a home, permanent, primary residence, as well as second homes, investment properties, and that market is going to correct and change. That's one of the first areas that you see corrections in the housing market is high-end second homes, luxury coastal environments, the investment properties and second homes. You see it in home builders, national home builders, they start to feel that impact first, and those types of things. But yeah, generally you'll see the money come out of risk assets go into hard assets when you have recessionary times and inflationary environments. But markets are contracting quick, and it's catching people off guard because they think it's going to snap back because everybody's waiting for the Fed to jump in and reverse course. So the question is, at what point do they do that, and how quickly can it snap back? And then what do they do? Do they sell when it gets back, or do they just, stay in for the long haul?
Yeah, this hodl strategy in an environment where you may have to wait 18 months for the Fed to reverse or even pause, that's a lot of pain you have to endure. And then it will take time to get back, and then you're just even, right? So it's
very interesting. I mean, 2017, 2018, when we had the repo crisis and we had the Fed raising rates, the market, collapsed about 20%, I think it was. Markets, all three of them, corrected about 15, 20%. It didn't take very long for that to snap back. I think it was less than a year it took to get back from that correction.
8 months, 8.5 months in that one. Yeah.
Yeah. So, and the NASDAQ's been a very different animal this year than it has in the past. Obviously, we saw March 2020. That was an extreme, outlier there with the pandemic and how quick that snapped back. But that still took, basically, looking at it now, well, it was about 6 or 8 months it took to get back, to the level before it corrected. But 2017, 2018, and then if you look at 2009, I mean, that took quite a while.
Oh yeah, that was what people don't realize. What people don't realize about that environment is I don't remember the exact percentage, but it was over 50%. Over 50% of the quote unquote .com stocks that went public didn't exist 5 years later.
Yeah.
Just like to your point, they went to zero.
Yeah, they went away. So people forget that, when you're dealing with stocks, those are instruments of a company that can go away, especially in the tech sector. So, my counter to Kathy Woods and people in crypto that say price just goes up, it's innovation, it's going to go up forever. You forget what this is. These are emerging technologies. A lot of these companies are emerging tech, emerging companies, emerging, they're nascent assets, and, they become obsolete very quick. Tech becomes obsolete very quick. Just like in the retail environment, consumers are fickle, fashions are cyclical, things get replaced or quickly, and these little trends come and go fast. But, and we're already seeing technology start to roll over in certain areas, and, that's what happens. And then you have the ones that are just flat out frauds like Enron, and, people forget about that stuff. And, a lot of people say it's very different, now from 2008, 9, and even the .com bubble, which it is. Very different environment because everything's become a meme.
Yeah.
The entire stock market has become a meme stock market, just like AMC, GME. It's investors just, jumping in and, driving these things up and then, dumping them on retail and getting out. And, I tell you, it's been a very interesting environment, but that's all with a Fed put. That's all with the understanding in the commercial real estate market, who's the biggest buyer of mortgage-backed securities? The Fed. In the stock market, who was the biggest buyer of treasuries? The Fed. All that money gets pumped back into the, to the equity markets because, if you're buying up the safe haven assets, where does capital go? Where does that other, $100 trillion worth of capital that's out there, investable capital, go? It goes into risk assets because there's no yield anywhere else.
Yeah. Amazing stuff. Well, I guess the last thing I want to talk about with risk assets or risk capital is the crypto environment, something you follow much closer than I do. Um, is that a place where you think capital is going to come out of, or do you think capital goes to as risk is repriced?
I mean, that's a small market. You're talking, on any given day, it's less than $2 trillion, 1.5 trillion to two. I mean, Bitcoin's, 800 billion to a trillion. The altcoins, that's the other half. So it's a very small market right now. But what I can tell you is there are a lot of investment banks and investment shops, BlackRock, JP Morgan, Goldman Sachs, everybody's setting up their trading desks because their clients want exposure to the space. So there is more and more capital coming into the space. It is rotating in and out of the stock markets. They are, it's like they're like tech stocks, the way they're viewed by investors. Bitcoin is a very different thing than a lot of the altcoins. In that segment of the market, there are a lot of those that are straight up scams. There's a lot of those that are going to go away and will go away. Bitcoin is never going away. It's not going to zero and it's not going away. The question is that investors are trying to digest right now. What's a fair value? What's the floor? And where is it going ultimately for a ceiling? And the upside targets are all over the map on that. What we do know is where it's been, 69,000 at the peak. And after the pandemic, the worst, type of economic crisis that we've seen recently, it went down to 3,500, 4,000. So we know we have a floor, we know we have a ceiling. So the question is, moving forward, where does it go from there? And markets are correcting right now as we speak, trying to kind of figure that out. And what a lot of people in crypto don't understand and don't realize is that they are seen by investors as a tech stock play. So that's where a lot of that capital came from to drive prices where they were, back in November, December of 2021, when you and I were talking about that's the top, when I was at Thanksgiving going, crypto has topped. It's time to get out.
I remember.
Everybody else was saying it's going to the moon. And, and then you hear these comments that it'll never go below a certain level and never go below a certain level. And then it goes below those levels. So what I'm saying is, what we know is when the pandemic hit and everybody thought the economy was going to shut down, it held up at $3,500, $4,000 Bitcoin. Wow. And then after that, it shot to 69,000. So that's our range right now of an extreme low and an extreme high that we've seen recently. And until you get a lot more capital into the space, which is what it takes to drive that price and to stay in the space, that's the only thing that can drive and sustain price. And the retail investors out there, they just don't have enough capital to do that. I mean, there's been some big buyers, there's been people spending $100 million, a day, trying to get to a $10 billion reserve with Luna, and that's not really affecting the market. Michael Saylor goes in and he buys. Market always drops after he buys. So the question is, does it drop after he buys because he's like some, bad sign or whatever? Yeah. Or is it because the market pumps knowing that he's getting ready to buy? So they pump the market for his buys and for, Luna buys, and then it drops after that. So, right now it's an unregulated space. There's not enough institutional buyer demand out there, and there aren't enough retail investors because most of the retail that got in, 70% of them got in the last year, and they all got burned.
They're upside down.
And as soon as it gets back to 60, 50, 60, 69, they're out because that's where they're breaking even, and they're not going to go through that again because they've tied up their capital for over a year now and they haven't made any money. They're down.
Yeah. Amazing stuff. How can people find you?
Yeah, GregDickerson.com. That's where all my info is. YouTube channel, podcast, GregDickerson.com.
Awesome. Thanks, buddy.